Well, good morning and welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional and owner of Shepherd Wealth Management. Happy New Year, everyone. Very excited to be doing another podcast today. 2021 was a phenomenal year, not only for the stock market, but also for Shepherd Wealth Management. The S&P 500 index for 2021 is positive, a little over 27%, including the dividends. And for Shepherd Wealth Management, also a great year. Started the company in June and finished the year very strong, coming up on just shy of $30 million in assets under management, which was the goal for the year. So very excited to be not only hosting the podcast, but looking forward to continuing to grow the business. There's going to be some really cool and exciting news that I'll be sharing with everyone here, hopefully within the next couple weeks or so. But for today's podcast, really what we want to be able to do is field some questions from real life fans of the show. I guess is the best way to describe it here. They're not clients yet, nobody that I actually work with, but we did receive a lot of questions. There was some really good podcasts that we've done recently. If you haven't seen them, check out shepherdwm.com. Very top of the website, there are some links to the YouTube channel for the podcast where you can see everything that we're doing here in office. There's also a link to the Spotify version where you can download the Audible and listen to that while you're driving around. But we had some really good questions that came from some of the most recent podcasts, and today we wanted to address some of those questions in the studio here. So without further ado, let's just jump right into this. So Ezra, my cameraman, my really good friend, brother-in-law, they're going to be reading off some of these questions that we have here for us. So Ez, let's go right to the text line. What do you got for us first here?
Let's do it. Text line's blowing up today. Shannon from East St. Louis, watching the market today, its movement combined with the impending interest rate hike make me want to throw into real estate, ? Looking for short gains. Your thoughts?
Yeah, so I love real estate investing. I am a landlord, so I do have rental property as part of my portfolio. So I never think it's a bad idea to look into something that is along those lines, a real asset that does produce income and can have capital appreciation to it. So in a year like this, so 2022, kind of the backdrop going into it, we've had a really good year, as I mentioned, in 2021. We've had several good years in a row in S&P 500 stock market performance. And now the market is what we're calling very liquid. The Federal Reserve has been pumping a lot of money into the market. A lot of analysts have given the backdrop as saying, yeah, that's a big reason why some of these sectors, specifically technology, has performed exceptionally well over the last several years. And now that the Fed is going to begin to tighten, meaning that they're no longer going to be buying as many bonds in the market, they should be finished with their bond buying of Treasury bills by sometime in March. So that faucet is going to stop, so to speak. And potentially, the Fed is also introducing this idea of increasing short-term interest rates. They call it the Fed funds rate. You probably hear that all the time in the news these days, like especially shows like CNBC, which we have here in the office, pumping all day long. So what does it actually mean, increasing short-term interest rates, this Fed funds rate? Well, that's the rate that the Federal Reserve charges other banks to borrow funds overnight to meet their deposit requirements. So historically, when we've seen interest rates be, we could go back into the 80s, somewhere between 16 and 22% was the highest rate of inflation that we've ever seen. And in order to deal with the inflation that we have going on right now, last I checked, we're looking at about 5 to 6% on the consumer price index, what we would call the inflation index. And the Fed would like to see that somewhere closer to 2.5%. So how do they go about doing that? Well, one of the levers that they can pull is they can begin to stop providing liquidity in the market space. And that's what they're doing by reducing their bond buying purchases. As I mentioned, that should be all wrapped up sometime in March. And now that they're no longer buying bonds on a month-to-month basis, they have another lever that they can pull to help reduce some of this inflation pressure that we're seeing, and that is by increasing short-term rates. So by increasing short-term rates, that means a couple things. Generally, what that means is for high-flying technology stocks or other high PE types of stocks, growth stocks, their present value is worth less as interest rates go up. So if you do just simple net present value calculation, interest rates are rising. Some of these positions that have PE ratios like NVIDIA, which is around 70 times forward earnings, there's going to have some price pressure because their present value is going to be worth less because interest rates are now up. But what that means for investors on the real estate side, the benefit of owning real estate in an environment like that, whether you're buying, Simon Properties, which is a publicly traded company, or you're investing in an ETF or a mutual fund that's a real estate investment trust, a big basket of real estate organizations and companies. The benefit of doing that in something like this type of environment, I would say, is it's a physical asset. It's easier for a landlord to increase the rent that they charge as opposed to a company like Apple increasing the price of the products that consumers are used to buying on a regular basis. So that's the real dilemma or dichotomy that we have to make a decision on as individual investors is, I've made a whole bunch of money in tech stocks and growth names, but now that the Fed is tightening, potentially increasing short-term interest rates, that puts pressure on some of these higher PE stocks. The benefit of something like real estate is it's a physical asset that will increase in value incrementally over time, not nearly as fast as something like the stock market over the long run. But it is a physical asset. It is easier to pass along things like higher cost along to their tenants. So that is the benefit of owning something like a real estate property investment, actually owning a company like a Simon Properties, or buying a real estate investment trust through an ETF or a mutual fund. So I like the idea specifically with the environment. It's not the only place that I would look for as a place to generate positive return, cash flow, and income, but given the backdrop that we're kind of walking into here in 2022, I do think real estate should have a place in everyone's portfolio, but positioning size matters. So in the past, because I'm a landlord, I don't actually have a Simon Properties or a real estate ETF or mutual fund in my own personal portfolio. But for those that don't want to actually be a landlord and deal with all the things that landlords have to deal with, like tenants and leaky plumbing and electric and all that sort of stuff, it's not a bad place to look at potentially increasing the percentage of your portfolio to something like real estate. But just like anything else, we don't want to have too many of our eggs in one basket, so to speak. So I would also look for other ways to drive income in this type of environment. And there's certainly some other ways to do that, whether you're using healthcare or something like banks, because they tend to do fairly well as interest rates go up. The reason for that, everybody watching this probably has a checking account or a savings account or both. You're likely getting 0.01, 0.05% interest on your checking and savings accounts. Well, if banks are able to lend, let's say a 30-year mortgage, as rates are going up, maybe it'll be 3.5%, 4% here in the not too distant future. Well, if they're able to get a lender paying interest at a rate of 4%, let's say, and they're only paying their checking account holders 0.05%, banks make the spread there. So there are other ways to generate positive results and cash flow in a portfolio outside of real estate, but I do think there is a place for that in a well-diversified portfolio. So good question. As I know, we got a few more. So what's the next one we got here?
Yeah, it looks like you're really hitting across the country today, man. The text line's blowing up from all over the place.
Love it. The show's catching fire, right?
It is, man. It's on fire. And no more so than locally here in Florence. Bobby's texting in, says 2021 was another great year for tech. Will tech be the best bet for large growth investments in 2022? It's Bobby with an IE. I love that.
Yeah, I do like that. That's a unique spelling. You don't get that a lot. So Bobby with an IE in Florence, y'all. So the question would be, if I understand it right, tech was the best performing sector for several years in a row. Is that going to be the place to be in 2022? So the first way to look at this question and try to come up with a logical answer. First of all, if you look at the S&P 500 index, if you were to look at the top 25 largest companies within that index, that's 40% of the whole index right there, just the top 25 largest companies in the United States stock market, right? That's 40% of the whole index is just those top 25. Of those top 25, a majority of them are going to be a technology type of name, whether that's the Apples, the Microsofts, the Amazons, Tesla would throw in there into a technology company, Adobe, like all these names. They're huge companies, and they make up a big majority of the S&P 500 overall index, but definitely that top 25. So if you're looking at 2022 and saying, well, there's really not a place to make a lot of money in the bond market, interest rates are likely to go up, There's actually negative yields overseas and all kinds of different types of risk associated in overseas types of investments, like China as an example. They've had a lot of outstanding performance years from a country GDP growth standpoint, which obviously has something to do with the increase in the number of publicly traded companies they have over there. But they've made some political changes, regulatory changes that have significantly hurt a lot of the publicly traded companies in that type of market. So you look overseas, you're not finding a whole lot of great value and opportunities. You look at the fixed income market, and you're saying it's going to be really, really difficult to make any positive results there without taking on extended amount of risk in something like a junk bond or what have you. So you can't expect the S&P 500 index to perform well in any year if those companies don't perform well either, because they just make up such a large part of the index. So I would say, is tech going to be the best sector of the market for 2022? That's difficult to predict. I do think that there are other sectors that could potentially outperform tech, like energy, possibly healthcare, would rival tech, but you cannot have the whole market go up without having technology be a part of that. So I do believe with a well-diversified portfolio, I'm not a Swami. I don't predict, what's the best sector of the market in any one quarter or any one year, because I'm trying to build wealth for my clients consistently over a very long period of time. But I'm always going to have at least a portion of the portfolio allocated towards technology because, like I mentioned, it's just too big a part of the U.S. economy. It's too big of a part of our global economy, and you can actually get international diversification through these tech names because they're selling their products and services internationally, and a lot of times 50 or more % of their revenue is generated from international. So international is going to be tough. Potentially, there are probably pockets where you can find some really good value. Fixed income is going to be really tough in a year like this where the Fed's tightening and increasing overnight rates. So I can't say that tech's going to be the best performing sector, although I do think it will be one of the better performing sectors, and it should be a part of a really well-diversified portfolio. I think the best way to approach tech, given the growth that we've seen over the last several years, it provides an opportunity for rebalancing, meaning that you can take some of the profits off of your tech shares, not maybe selling all the shares, but just some of the shares that produced a profit, and use that capital to reinvest into other parts of your portfolio that probably underperformed tech over the last several years. Things like your financials, as I mentioned, they're likely to do well in a rising interest rate environment. Things like healthcare should do very well given not only the pandemic that we've come out of, but obviously there's an aging population here in the United States. So there are several other sectors that could do better, but you at least have to consider having technology still be a part of the portfolio. I would just maybe rebalance it, take some of those gains off the table, and invest elsewhere. So good question. Bobby with an I here in Florence. IE. Sorry. Thank you, Ez.
Yeah.
But yeah, that's my thoughts on that. So let's roll on to the next question here.
All right. Next question's coming in from Tom in Anderson Township, Ohio. Tom says, on a fixed income retired, while interest rates remain low, my returns are dismal. Any advice for income producing investments in 2022?
Yeah. Like I mentioned just previously, it's going to be really difficult to look at something like the bond part of the market and say, well, there's going to be a lot of gains here, a lot of income to be had. So where do I get income producing investment ideas, I think is the heart of the question for 2022. I think we've touched on some of it already with the first question, about real estate. There are a lot of opportunities to generate a nice stream of income. Generally, things like real estate investment trusts tend to pay out a higher rate of interest because, like I mentioned, as rates go up, they can pass along that cost to their tenants. So that's one place to look. I would definitely make sure if you're looking at things like ETFs and mutual funds, they're a basket of those type of companies. So you do want to have a good understanding of at least what some of the top holdings are of that ETF or that mutual fund that's investing in real estate companies. Or you could just simply go out there and say, okay, I'm interested in this real estate ETF, and I look at the top 10 holdings, and all of those names are publicly traded companies right here in the United States. That might be a decent place to start to look at real estate companies, the individual publicly traded company name, and compare and contrast to their competitors in the same space. Something like a Simon Properties comes to mind. You can also look at alternative types of investment opportunities like United Rentals, which is also a publicly traded company that's typically easier for them to pass along their inflation costs to their tenants that are renting those units. So I would definitely look at the individual real estate companies. I would look at the real estate investment trusts. I would certainly look at alternatives, like I mentioned, United Rentals, and then other opportunities to generate income in this environment. So generally speaking, when the market gets very volatile, people tend to gravitate towards safety. So one of the safe havens in a potentially volatile market, and volatility can come about for a lot of reasons, whether it's inflation, whether we still have this COVID issue that's causing supply chain constraints, which also increases inflation. It could be the midterm election could cause some volatility, which usually is very short-lived. But if you're worried about volatility and the goal is to produce income, I think another safe haven to consider is something like telecommunications. So regardless of whatever happens in the midterm, regardless of whatever the Fed does, regardless of whatever the actual U.S. economy does, everybody that I know of here in this country has a cell phone. There's probably more cell phones and tablets than are human beings here in this country. So people will continue to, pay their cell phone bills. So that's an opportunity for you to drive some income and potentially some additional capital appreciation from publicly traded companies like a Verizon, AT&T, and T-Mobile, all of which pay above average dividend yields. Another safe haven asset class to look into if you're worried about a volatile market in 2022 and you're looking for income are things like your staples, your Kroger's, your Costco's. Those types of companies typically pay a dividend, and they're generally very, very stable as it relates to when the overall market gets very, very volatile. And last but not least, you can always look into things like utilities. Waste management company is also another way to play that. So those are just some general ideas that I think a lot of people on CNBC and Fox News and CNN, they're talking about this on a day-to-day basis as if the market's just going to completely pivot to these more safe haven asset classes. That is not a given. So I don't want to make all these statements and answering these questions and say, well, this is what we're doing here at Shepherd Wealth Management. We're shifting out of technology, we're shifting out of growth completely, and we're just go ahead and adding in all these more consumer staples types of investments or real estate investments or healthcare investments. That's not it at all. I do not like to build portfolios or provide investment recommendations based on the flavor of the month or flavor of the quarter or even for the year. What we want to be able to do is sit down with a client, have a logical conversation about what is important with this money. Why are we even putting capital at risk here? What's the end result that we're looking for? What types of returns or income do we need to get along the way to take care of our short, intermediate, and long-term needs? And then build a portfolio and a strategy around those things. And those goals that the client has is not going to change month to month, quarter to quarter in most cases. And if it is, great. We're going to talk about it during our quarterly reviews anyway. But we do not build portfolios here, and I would not advise you to build a portfolio just based on the flavor of the month or what everyone expects to happen in the market, because the truth is nobody knows month over month, quarter over quarter, what exactly is going to happen. If that was that easy, then all of us could just turn on CNN and Fox News or CNBC, whatever your favorite news outlet is, and if they're all saying the same thing, and we all invested the same way, then we can all make a lot of money with no risk. I certainly would not have a job. But that's just not reality. So I don't build portfolios for a flavor of the month. These are just general thoughts about some of the questions that we're receiving here and how I would use what's going on today in the market and how I might reposition a portfolio. But we're talking minor adjustments here, maybe taking 1 or 2% away from some of our favorite growth names over the last year and allocating 1 or 2% to some other asset class. To me, that's the best way to go about managing risk and still keeping your portfolio in a situation where you can capture gains regardless of whatever happens. So if tech gets hurt for a little bit, great. Well, you've already added some of these healthcare stocks. You've already added some real estate in there and some utilities. Now you're kind of balancing out your portfolio between high flyer growth names and some of these more stable type of names when the market gets very volatile. So those are my thoughts about generating fixed income in a year where you're potentially likely to see the Fed tighten, see interest rates going up a little bit. But it's not like you should just take everything and move in that direction. It should be a rebalance. It should be a repositioning part of the portfolio, not just starting over from scratch and building portfolios based on whatever news you're seeing, that day or that quarter. So what do we got next, Des? That was a great question from Tom out in Anderson. Thanks, Tom.
Next question comes from Louisville, Kentucky. Hannah in Louisville wants, let's see. There's a batch of new electric vehicles hitting the market this year. Will Tesla stay the gold standard in 2022 that it has been? Or are there other investment strategies to take advantage of this industry's imminent boom?
Yeah, Tesla's been on a absolute tear. I can't think of a company that's grown faster than a Tesla has. And I got to say this too, because I've been in the investment game, if you will, for about a decade or so. And Tesla was one of those names when they went publicly traded. They really didn't have any revenues. They're obviously fighting an uphill battle with much bigger players in their space. They had to kind of build out basically everything. And Elon Musk was the main reason why everybody was super excited about it. And the truth be told, for me, when I looked at Tesla on paper, because I'm a big fundamental analysis kind of guy, I did not foresee Tesla 8 years ago becoming the type of company that it is today. So, my applause to Elon Musk. Hats off to him. Absolutely phenomenal job. I can't think of another company that's anything close to a Tesla. So they definitely have a advantage as it relates to their brand name. They've already produced a record number of vehicles in their most recent quarterly call. I don't think any of that stuff is going to slow down anytime soon. But Tesla as a company, if you're just looking at the fundamentals like I am, it's a very expensive stock, not just on the price per share, but if you're looking at things from a fundamental lens, like their price to earnings ratio, I'm looking at it right now, it's 389 times their actual earnings. So that's a very expensive stock, which is why you've probably seen over the years a lot of analysts and hedge funds shorting Tesla stock, not because they didn't believe in Elon Musk per se, or they didn't like how cool the Tesla vehicles were. They were just looking at it from a fundamental standpoint and saying, hey, this thing cannot continue to run the way it has forever. Well, all those short sellers were definitely proved wrong. So I'm never going to bet against an Elon Musk, but at this point, based on just the fundamentals that I have seen this stock have for many, many years now, it just doesn't make a whole lot of sense to allocate something like a Tesla to a portfolio. Now, if you've had it and you benefited from the gains, absolutely, congratulations to you. You should give yourself a huge high five and a pat on the back because I did miss that investment. But what I would also say is, you definitely don't want to get too greedy. And it's definitely an opportunity for you to rebalance that position itself, take some profits off the table and reallocate that. But to answer the question here, what other types of investment opportunities should investors consider adding to their portfolio given the demand that we're seeing around the world for electric vehicles? So here are my thoughts on that. I think a simple way to play it is, of course, anybody could go in and buy Ford or General Motors or Volkswagen, or you pick your favorite automaker. Virtually all of them are moving towards producing a lot of electric vehicles. Now, the issue with doing it the simple way, by owning, like I said, the Fords or General Motors or what have you, the issue with doing that is all of those companies have to spend billions of dollars building out manufacturing plants, investing in equipment, investing in human capital. All this stuff takes a lot of money and it takes a lot of time before it all is completely ironed out and is exactly the way that those CEOs and board of directors wants it to be. So with that being said, if you're looking at simply buying a General Motors or Ford, or you pick your favorite automaker outside of Tesla to benefit from this electric vehicle movement that we're seeing here around the world, the issue with that is all those CEOs and those board of directors and the investments that they're making, these multi-billion dollar investments are going to take a long time. If they don't allocate their resources very well, if they don't get the plants built on time, if they don't have enough people to put in the factory to make the parts and actually make the vehicles themselves, if they don't do all that just right, then it could be a very volatile position in your portfolio, because that doesn't even take into consideration all the other things that affect individual companies, like presidential change, other political risk, The interest rate environment that we're in right now. It could be, we could still see inflation, 5-6 years from now. Who knows? We don't know for sure. So because of that unknown, you're making a bet on companies' ability to produce a whole lot of vehicles that they never produced before, to work out over a long period of time. So that's the risk by doing it the simple way of owning a General Motors or a Ford, is you just don't really know between now and the next 5 years, let's say, when everybody wants to have 50% of their sales be electric vehicles, you don't know if that timing is going to play out, over 5+ years. Whereas you do know the demand for electric vehicles is likely not to change, I'd say, over the next 5 years. So how can we play in this space and benefit from all this demand that these automakers have and that consumers have for electric vehicles without actually buying a Tesla, General Motors, a Ford, or whatever your favorite automaker is? I think the simplest way to go about doing it would be through an ETF, an exchange traded fund. And the main component of this battery, this electric battery, is lithium. There is actually lithium ETFs out there. One of the ones that I've used for my clients is ticker symbol LIT. And that is an ETF that's investing directly in companies that produce lithium, which is, again, the main component for the batteries for all these electric vehicles. Now, obviously, the demand isn't going anywhere. So that's the best part about this investment play, right? You can benefit from all the demand for electric vehicles, and you're investing directly in the main component of that battery. That's obviously the most important part of the entire automobile. Simple way to go about getting into that. But the risk is there could be somebody else, like an Elon Musk or somebody else that we haven't heard of yet, that comes up with a way to get the same type of energy without using lithium. We don't know what that is. At least I certainly don't know what that is. So it's always a risk. It's always a possibility. There's always going to be somebody out there looking for another way to do something better, cheaper, faster than what we're doing right now. So if it's possible for batteries to be made without lithium, or for electric vehicles to be made without using lithium, of course that investment play isn't going to work out. But if we don't come up with another material to power these electric motors, these batteries, then I think it's a fairly safe bet in that the demand for the electric vehicle probably isn't going anywhere anytime soon. And buying the exchange traded fund, the lithium ETF, is a simple way to play into that growth without actually buying a expensive automobile manufacturer. So it's a very interesting question, something I've given a lot of thought to for my clients in building their portfolios last year and coming into this year. And the way that we've handled that is not actually buying an automobile company, but we've actually owned the lithium ETF. So great question. Let's get to our next one here. I think we got time for one more.
Yeah, time for one more. Randy Q out of Lexington, Kentucky says, growth stocks have massively outperformed value stocks the last several years. With the Fed about to tighten, do you see that performance flipping? Good question.
It's a really good question. I think we touched on some of the answer here in a previous question, is that growth absolutely has outperformed value stocks for several years in a row now. And with interest rates, likely to go up, it's unlikely that growth stocks can outperform small cap stocks or mid cap stocks forever. Eventually, there's going to be this reversion towards the mean. And 2022 very well could be that reversion towards the mean. I think a lot of analysts on Barron's or CNBC are actually calling for value to potentially outperform growth in 2022. Although, again, over a short period of time, like 12 months, nobody knows for sure exactly what's going to happen. So Morningstar came up with what they call style boxes. So size and style. Size meaning small, mid, large cap. Style being value versus growth. So a big part of your portfolio's return over a short span of time, like a year, certainly will have an effect on how you position things, meaning how many value positions versus growth positions do you have? How much weighting are you giving to large cap versus small and mid cap? So all that stuff definitely matters when building a well-diversified portfolio, and all that stuff matters when you do the calculations at the end of the year to actually see what your return is. And certainly all that matters into the level of risk that you're taking with the investments within that portfolio. But I'm not going to call out growth just yet because we're still certainly in a very low interest rate environment. Even if the Fed actually does increase short-term interest rates 3 times in 2022, that's still going to put us somewhere between 0.75% and 1%, which historically is still very low. And if you factor in things like inflation, you still have, a negative interest rate on things like cash or cash equivalents. So I cannot count out growth just yet, but I do think it is prudent for investors if they don't have more value positions in their portfolio. So if they don't have, your small cap value ETFs or those mid cap value ETFs and those types of things, or individual companies that can easily be described as value companies like a Berkshire Hathaway or Graham Holding Company, those types of positions, in my view, certainly are value positions because they have a very low PE ratio, and the way that the board and CEO kind of handles things is much different than the way that Tim Cook at Apple makes decisions in his investments in his company. So to me, since we don't know for sure exactly which area of the market, growth versus value, is definitely going to be the winner, because I don't think anybody can talk on a podcast or write an article or be on TV and say, for sure, I'd be willing to bet all of my paycheck, or my house on value outperforming growth. I would not feel comfortable doing that for sure. I don't think anybody else would either. So what I would play is, again, I would look at it as an opportunity to rebalance. If you're expecting the market to get very volatile, if you're expecting rates to go up, if you're expecting the Fed to continue to tighten, and you're expecting maybe the political risk this year because we're in a midterm election to cause additional volatility as we get towards the end of the year, you definitely don't want to have all of your eggs in either value or growth. Because like I mentioned, we're still in a low interest rate environment. It still provides a runway for these big companies, these big tech names to still do very well. I expect their earnings to be fantastic, actually, for most of the tech sector, specifically for chip stocks. We talked about the demand for electric vehicles. Well, there's plenty of demand for computers and electric vehicles, and gaming and all that stuff needs chips. And chips are also going to be a big part of the growth story here for 2022. So you just don't want to ignore any one area of the market, but you do want to be cognizant of what actually is going on. So the way that I would play this is I would look at it as an opportunity to rebalance. So we made a lot of money over the last several years. Tech led the way. Let's go ahead and take some of those profits off the table so the market can't take that away from us. And let's use that money to invest in things in our portfolio that we've maybe underappreciated, or maybe we don't have some of these small mid-cap types of positions. Now we can take the profits out of tech, allocate it towards something like these value investments, and now we've built a really nice diversified portfolio. And regardless of whatever happens in the market, whether growth outperforms value or vice versa, we still have exposure, and that provides additional opportunity to rebalance. So if we make this change, take some money out of tech this year, allocate it to value, and then value actually does outperform growth, well, there's still a really good chance that growth did well, just not as good as value. And because you've made all this money in your value investments, now you can do the exact opposite going into 2023. Now we can maybe take some profits off of our value positions and allocate that to something like tech, potentially, where it didn't have as good a year as the value investments may have. So it's all about controlling the asset allocation. At the end of the day, if you're a long-term investor, long-term meaning 5, 10 plus years down the line, the one thing that you're always in control over, I would say 2 things, is your asset allocation, the percentage of your money invested in stocks, bonds, and cash, and you're in control over your temperament. So whatever you see in the news headlines, your favorite articles, your Barron's subscriptions, your New York Times, your CNBCs, MSNBCs, whatever it is, take all that information with a grain of salt. Take that information, digest it, do your own homework, and that's how you can begin to make your own decisions about how much of your portfolio deserves to be in growth versus value, income versus stability. All those decisions are very important, but the 2 things that you'll always have control over no matter which way you go is your asset allocation, and that's probably the most important driver of performance and definitely the most important driver of risk, because over that 5-10 year period of time, that percentage of money invested in stocks, bonds, and cash, that dictates 94% of the variability in your portfolio's performance. So you can control your asset allocation. You can also control your temperament, And the best way to handle that is once you see these headline news, and it probably will shake you to your core at times. You see some really bad news going out there, and you're thinking, man, this is going to be, the end of the growth cycle, or, the sky's falling and I need to sell out of everything and buy gold. Whatever your gut reaction is, take a step back, write on a sheet of paper. Hopefully you've already done this for yourself, and say, why am I investing? Why is it important for me to put my capital at risk here today? Oh, I'm doing this because I don't actually need the money for another 10 years. I'm doing this so I can take care of my kids' college education that they're going to have to pay for over the next 6 years. I'm doing this so I can leave a legacy and I have longevity in my family, and I want to make sure that there's something left behind from the surviving spouse and our kids and grandkids. All of that taken into consideration, and I step back and say, well, this is actually stuff that's going to happen over many, many years. Why am I getting so emotional about the headline that I just saw here today? That should help you put yourself mentally in the right place for you to look at things logically and thoughtfully and make prudent investment decisions. Like I mentioned, rebalancing the portfolio, just making small shifts within the account, value versus growth, tech versus healthcare, whatever the case may be, puts you in a better spot to control the risk and gives you a better probability of getting the types of results you're looking for, as opposed to letting the market and the news headlines kind of dictate how you go about managing your portfolio. So those are the things that we do here for clients at Shepherd Wealth Management. It's worked out very well for us in 2022 or 2021. It will work out for us well in 2022 and well into the future. It's a great list of questions here that we're able to cover today. These are the types of things that are on my mind on a day in and day out basis when I'm sitting down and meeting with clients and we're doing quarterly reviews and considering making changes within the portfolio. These are absolutely the right types of questions that we would hope to generate from this type of podcast to help you think a little bit more critically and give you some thoughts and ideas for the future and how you want to be positioned for it. So hopefully everybody got as much out of this as I certainly did as I was preparing for today's podcast and answering some of these questions. If you have further questions or something that you wanted to ask that we didn't actually cover here today, give us a call, shoot us a text message, 513-630-2664. Don't forget to check out my website, shepherdwm.com. There will be a link at the top of the page. It's a whole bunch of information about me and my background and experience, but there's also a link for our YouTube channel to watch the podcast, not only for today, but others that we've done in the past. If you're driving around, there's also a link for the Spotify version of the podcast that we've done, both today and in the past, where you can listen to the Audible version. And certainly don't forget to check out the Shepherd Wealth Management pages on Facebook, Instagram, and Twitter. Like us, follow us. Feel free to pop a question there too if you'd like. This has been an absolute blast. Ezra, I appreciate very much for you reading off the questions today.
Anytime. Yeah. Glad to be on the other end of the mic.
Yeah, we'll have to do this a little bit more often. I had a lot of fun today. Hope you all enjoyed it. Have a great rest of your day.